I'm sharing an easy explanation of the question, what is the dividend yield, using Apple dividends and some of the biggest risks to dividend stock investing. I'll not only show you how to calculate the dividend yield quickly, but reveal 5 dividend stock strategies for higher returns without the risk. We're talking dividend yields today on Let's Talk Money.
Beat debt,
Make money,
make your money work for you.
creating the financial future you deserve.
Let's talk money.
Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to everyone in the community. Thank you for taking a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Now, probably no other measure in dividend investing is as popular or as dangerous as the dividend yield. And it makes sense, right? That's your cash return, and investors are all about getting as high a return as possible. In this video though, I'll explain the dividend yield, how to calculate it, and some risks around it. We'll talk about what's a good dividend yield, and then I'll reveal 5 dividend investing strategies you can use for solid returns. Now, this is a hugely important topic, not just for the dividend investors, but for all stock investors. I've gotten a lot of questions about our 2019 dividend stock portfolio, why I filtered for stocks paying a 3% yield or higher instead of going for those really high yielding stocks. You only need to look at that 24% total return in just the first 4 months to see that it's all about that balance and getting the highest total return. 5 of our dividend stocks are up over 35% so far, with Hanesbrand surging 67%. Now, a stock's dividend yield is the cash return you get on that investment on a yearly basis. Now, that's important because most stocks pay their dividend 4 times a year, but only pay a fourth of that annual yield. So you might see a 3% dividend yield and receive a dividend every 3 months, but you're only collecting that portion of the annual yield, only a fourth of it each quarter. Let's look at an example with the Apple dividend because it gets much easier when you can see how this is applied. We see here that besides having a very good day after reporting first quarter earnings, Apple is trading at $214 a share. Now, this forward dividend and yield reported here is for the entire year's payments, so investors should expect to receive $2.92 in dividends for every share of Apple they own. What you'll actually receive is 73 cents every 3 months, but remember, we use that annual number to calculate the dividend yield. So if we take that $2.92 in dividends received over a year and divide that by the current $214.16 share price, we get a dividend yield of 1.36%. Now, it says 1.54% here as the yield, and that's an important point you want to remember. This 1.54% yield is based on the stock price yesterday, so it hasn't updated on today's big move. Understand that as that stock's price increases, if the company doesn't also increase that dividend payment, then the dividend yield will go down. Conversely, if a stock's price falls and the dividend payment stays the same, the dividend yield is going to go up. Now, if Apple shares were to fall to $175 each and the dividend payment stayed at $292 a year, then investors would be getting a 1.66% yield. This uncovers one of the biggest risks in looking at just the dividend yield. If you see a high dividend yield, you also need to look at the stock price over the last year. If the shares have been falling and that dividend hasn't been cut, that's going to increase the yield, but it could be a dangerous assumption. First, if the company is in too much trouble, it might cut that dividend to conserve cash. Just as importantly though, what good is it to collect that hefty dividend if you lose double that on the stock price? So dividend yield is important, but it's not the only thing you should be looking at. That's going to be big in these 5 dividend investing strategies that we're going to talk about now. First though, if you're liking the video and you think the information is helpful, do me a favor and tap that thumbs up button below and let me know in the comments. So a good dividend yield is just what you can get while still getting some of that upside return on the stock price. We talked about this idea in our dividend payout ratio video. A company can return all of its cash to investors through that dividend, but there's going to be no money left for growth, and it may even lose competitive share against its peers, causing the stock price to fall. That means when I'm looking at a dividend yield and the payout ratio together, I'm looking for companies with a commitment to return cash, but also to grow the company. Now, that generally means a good dividend yield is between 3 to 6% for regular stock companies. Since the dividend yield on the market, the S&P 500 is just under 2%, companies in this 3 to 6% range are well above the average and are demonstrating that yield commitment. Now, I know that a lot of investors want to go for those highest dividends yields they can get, investing in stocks with double-digit yields, and if the stock prices doesn't fall, then that's not a bad return. A lot of times though, weakness on the share price and that volatility just isn't worth that marginally higher dividend. Let's look at those 5 dividend investing strategies though, because a few of them will really help you get those higher yields with the same solid price returns as well. Now, one of the most popular dividend strategies is investing in monthly payers. Now, we've seen that most dividend stocks pay out just 4 times a year, and that can make it difficult to plan for paying expenses or if you're living off your dividends or just that passive income stream. That's where monthly dividend stocks come in, companies with a policy and a history of returning cash to investors every single month. Even better, these stocks have a median yield over 8% annually. That's over 4 times the dividend yield on the broader market, that S&P 500. Now, these are some great opportunities to create that monthly cash flow that's either going to be growing your portfolio or just give you that extra cash each month to pay the bills. Now, I am going to warn you though, these monthly payers tend to be in just a few different business types. We see here that about 40% of monthly payers are real estate investment trusts. Another 38% are business development companies, BDCs, and then some energy companies, usually master limited partnerships. We also see the average dividend yield in each of these groups, so 7.4% on MLPs, 7.5% on REITs in that space, and a whopping 10.1% average yield on those BDCs. Now, there's a reason for this that we'll talk about it and why these cannot be your only investments in dividend stocks. Again, do not think you can put together a portfolio of just these monthly dividend stocks because it's going to put all of your money at risk. Now, we see in that graphic, putting all your money here is going to grossly expose it to just a few different business structures. These companies set up as BDCs, REITs, or MLPs get that special tax break, but you have to pay out almost all of their earnings as dividends. That means they tend to have volatile share prices because they have to raise money regularly through debt or equity, and they are highly exposed to rising interest rates. Now, these monthly payers also tend to be much smaller companies than other stocks. For example, of the 28 legit monthly payers I follow, the average size is just $723 million, with the largest only about $20 billion company. Now, that might seem like a lot, but it's minuscule next to the trillion-dollar companies like Amazon and Apple, and none of the S&P 500 companies pay monthly dividends. The fact that these are much smaller companies with less financial flexibility just means you need to stay up on those usual warning signs for dividend stocks. These include sales growth, debt leverage, and some of those other signs that we've talked about on the channel to stay ahead of these stocks. You also need to understand the management structure in those business development companies, the BDCs. It's either going to be external or internal management, which is going to make a big difference on how they're compensated and how that works in with the dividend. Now, external management is usually compensated by growth in the company's invested assets, so they want to make as many investments as possible, even if they're not necessarily great investments. Internal management compensation is tied more directly with investor returns, so these are the companies you want to look for. Now, finding these monthly dividend stocks is pretty easy with any stock screener or a Google search on monthly payers. What I want you to consider when you're using this strategy, though, are just a couple of points. First is to make sure that you spread your dividend portfolio across different sectors and different business types. Now, that probably means only having a chunk of your dividend investments in these monthly payers, since they're mostly in those REITs, MLPs, and the business development corporations. Second is to pay attention to the share price over the last few years as well. Don't get caught up in that high dividend yield because you don't want it to be at the expense of a falling stock price. Now, we've got a complete video on the channel about investing in monthly dividend stocks, so I'll leave a link to that in the video description below. Now, one dividend strategy we haven't talked about on the channel, but actually has a lot of research to support it, is the Dividend Aristocrats strategy. Dividend Aristocrats is the name given to companies in the S&P 500 index, so we're talking companies of about $5 billion or larger that have increased their dividend payment for at least 25 consecutive years. Now, nearly 3 decades of increasing dividends is a huge commitment, especially considering that this includes that 2008 recession, which was the worst in 80 years. Stocks that increase their dividends have been shown to outperform the rest of the market, and these aristocrats are a great way to play on that. Now, that list peaked at 64 stocks in 2001, but has since fallen back to 57 companies that meet the filter. Over the decade to March 2019, the Aristocrats has returned an annual 17.6% return versus a 15.9% return on the broader S&P 500 market. Not only has it outperformed the market, but the Aristocrats index has also done it with less volatility, so less of those violent ups and downs on the prices. Now, instead of trying to keep track of all 57 companies in the Dividend Aristocrats list, there are a few funds like this ProShares ETF, the ticker NOBL, that's going to do it for you. The fund holds all the stocks in the Aristocrats Index and it has a 2.3% dividend yield. What I want you to notice though, if you're going to invest in this fund or the Aristocrats stock, is the sectors within the fund and their weightings. Most of the fund is in just a few sectors like consumer staples, industrials, and financials. Now that's obviously a function of how safe these sectors are for cash flow and how the companies have been able to keep increasing that dividend year over year. But you might also want to pair this fund with another that has maybe a growth stock perspective. The reason here is that way you get more from stocks like sectors like tech, consumer discretionary, and others to balance out those heavy weightings in just these three sectors in the Aristocrats fund. Another strategy, actually my favorite dividend yield strategy, is investing in real estate investment trusts, REITs, and master limited partnerships or MLPs. So like we saw in that previous strategy, these are special types of companies that get tax breaks for returning most of their cash flow to investors. Not all of them are monthly payers though, and I think some of the best picks are actually those normal quarterly paying stocks. So REITs or real estate investment trusts are companies that own and manage property, usually commercial real estate property. The company pays expenses, then passes through at least 90% of the earnings to investors in that form of a dividend. Now, investing in REITs, it's important to spread your investment across companies within different property types like office, warehouse, hotel, data centers, retail, industrial, and self-storage. MLPs or master limited partnerships own mostly pipelines that transport oil and natural gas and then the storage facilities to hold them. They collect a fee from other energy companies for using those assets and pass most of their earnings on to investors. Since much of their fee is based on that amount that goes through those pipelines or is stored in the tanks, they aren't quite as dependent on energy prices, so it can be a great way to lower that risk of weak oil or gas pricing in your investments. With REITs and MLPs, I want to cover two very important points to help you when you're looking for these stocks. First is that taxes on the investments are handled very differently. So taxes on dividends from REITs are like any other dividend stock. If you hold the shares for more than 60 days around that dividend payment, you pay a lower qualified dividend tax rate and you pay those taxes each year on the dividends you collect. One of the best pieces of advice I can offer with a dividend investing is to hold these high yield stocks in a retirement account, so either an IRA or a Roth IRA. That's going to save you from having to pay those taxes each year on the dividends, and it's going to seriously boost your returns in these stocks. Now, MLPs, master limited partnerships, are taxed entirely different. For each MLP company you own, you'll get a special tax form each year called a K-1 form. Now this is going to be breaking out the dividend between a return of capital and a normal dividend portion. Now that return of capital portion of the dividend, and this usually ends up being the majority of that dividend you collect each year, isn't taxed each year. It actually goes to lowering the taxable price you paid on the shares, so you don't get taxed on it until you sell your shares as capital gains. It's a huge tax break, shielding you from that annual tax hit on the full dividend, but it also means that you don't want to hold these in that retirement account. Hold these MLP investments in a regular taxable investing account so you take advantage of that tax-deferred benefit. Now, the second point I want to cover for REITs and MLPs, and this is the biggest mistake I see investors make on the two investments, is that you can't use a lot of traditional value measures. So these companies own assets like real estate and pipelines, and that means a huge amount of depreciation on the income statement. They take that depreciation off their earnings to lower taxes, but it also means that earnings are a terrible view of profitability for these businesses. So if you ever hear anyone talking about the price to earnings ratio of an MLP or a REIT, they don't know what they're talking about. You can't use the PE ratio for these types of stocks. There's a special way to value each of these types of stocks, and I'll show you how to do that for each. What we're going to use for MLP stocks is what's called the price to distributable cash flow, or price to DCF. Now, finding this value for distributable cash flow, the amount of money the company has available to return to investors, that's important also because it gives us an idea of that dividend sustainability. A company can't pay out more than it's available forever, so it's a good metric to make sure that that dividend isn't going to be cut anytime soon. Now, I'll show you how to calculate the DCF yourself, but all MLPs are going to calculate it on their financial reporting. I do it myself only because I like to double check the numbers coming out of the company and make sure I'm comparing stocks with the same type of calculation. So here's the table, and again, don't get freaked out because this is always provided for you in financial reporting. To find out how much money the company has available to distribute, you take that cash flow from operations. This is always going to be found on the statement of cash flows, and you remove any spending on capital and income from non-controlling interests. That gives you sustainable DCF, which is what the company can return to investors and still keep operations running smoothly. Now, while sustainable DCF is a better measure, most people use the DCF as reported because it's sometimes the only number reported by the company. To get to DCF, you also add back the income from non-controlling interests as well as working capital reported. Now the big one here is just adding back this proceeds from asset sales. This is technically proceeds the company can return to investors, but a company can't forever be selling its assets and still keep in business. So that's why we use that sustainable DCF if it's available. With this number, you can find that valuation with the price to DCF, or you can find how much the company is returning to investors by what's called the distribution coverage ratio. Now this is how much the DCF the company earns versus how much it pays out. Now just like with MLPs, you can't rely on the reported earnings for a REIT because of that high amount of depreciation they get from those real estate assets. Instead, we use a measure called the funds from operations, or FFO. Now FFO is very similar to that DCF that we saw with MLPs. You take the reported net income of a REIT, then add back depreciation, but minus out any gains that they made on property sales. Those property sales are a source of income, but again, not something that a REIT can do forever and expect to stay in business. Remember, the idea here is to find out how much a company has available to distribute without cutting into the money it needs to run the business. Again, like the DCF calculation for MLPs, you don't necessarily have to do this yourself because it's always reported by the company. It's just a good idea to understand the concept and be able to double check the company's reporting when they give it to you in their financial statements. Now you use the FFO just like our other metric for MLPs, so you can take the price of the REIT over the FFO to compare the valuation to those other REITs. You can also get a coverage ratio of the FFO over the dividend to see how safe that yield is for the stock. Now we've also got a video on the channel that goes into more detail on investing in these REITs and MLPs, so I'll leave a link to that in the video description below. We're about halfway through our 2019 Dividend Stock Challenge portfolio and the stocks are blowing up. This portfolio is up over 24% so far and beating the market by nearly 10%. I'll leave a card here in the corner and a link in the description as well to see how we picked those dividend stocks for your portfolio and how you can join the challenge. We're here Mondays, Wednesdays, and Fridays with the best videos on beating debt, making more money, and making your money work for you. If you've got a question about money, just subscribe to the channel and ask it in the comments below. We'll make sure you get an answer in a future video.